Hello friends, this is Rajat, managing partner at premium wealth management firm Finogent Solutions. So today we'll be talking about an investment strategy, an asset class that has given around 7.5% return in the month of December 2024. Yes, when the market was having a bloodbath that gave around 7.5% of the return. We're talking about the asset class today, which has got around 12 trillion rupees of commitment as of 2025. And we are today talking about an asset class in which no other Tom, Dick, and Harry can invest into. Yes, this is an asset class which only is a chosen choice of ultra high net worth individuals or a high net worth individuals. Yes, we are talking about alternative assets or alternative investment funds. But before I should go and explain what it means, what are the opportunities there, why they are so much popular these days among the HNIs, let me put it forth that in this video you will know about how to approach an alternative investment funds in terms of having that as a part of your kitty. Traditionally, what happens is whenever a fund comes and an AIF and as an investor, you get okay, X and Y AIF has come, or they are their XIRR returns or IRR returns, and let me get into it. So this is a normal way we approach as an investor. However, do you know that there are three different categories of the AIF? And three different categories cater to totally three different aspirations, choices, and the risk return trajectory, or even your expected returns. Not only that, AIFs are they are very niche products and are very qualified to go and identify the opportunities into the different landscapes. So therefore, what is more important for you is to identify which AIF suits you. So in this video, we'll be talking about alternative investment funds, why they are getting so much popular, why they are giving so much of good returns, and why and how they are so much decoupled or diversified and very much risk adjusted in terms of standard plain vanilla products like mutual funds, stocks, bonds, and deposits for that matter. So therefore, to start with, what is more important for us as an investor is to know what an AIF means as per the definition. Like alternative investment funds, it is a fund that invests into investment options which are different from traditional options available to you. For example, mutual funds, stocks, bonds. Now they are traditional investments. Now they are so much retail oriented and the mass market that there are more and more regulations into it. So therefore they have to be more diversified, more spread out. So therefore, if there is an investment opportunity that is very good but very limited and you cannot have it full blown, it may not otherwise seem tangible to take advantage of, not only from the viewpoint of the investor profile but also from the sheer size of that opportunity. So therefore, that is the reason why you come to know that alternative investment funds are looking forward to a maximum cap of, say, for example, 1,000 crore, and a minimum investment amount for an alternative investment fund for an investor to invest into is 1 crore. So they're just looking at 1,000 investors. That's it, and after that the AIF is closed. So therefore, alternative investment fund as a definition means an asset which is alternate or different from that which is available. However, it also means that it is an alternative way or not a traditional way or an alternative way of investing and managing. For example, like hedge funds. So you can go for a category 3 AIF which still invests in pure equities like stocks, but the way of their investments or the strategy is totally different, which makes it starkly different from the traditional equity products or the mutual funds. So therefore, that is what an AIF is for you. Second most important thing that comes, why is it so much important for a high net worth individual? No, they are actually having wealth preservation as a primary objective, and that is being taken care of. Now they are having a problem of plenty. They are having money, disposable money, but they actually want it to provide more returns, better returns, and exorbitant returns, or let me say exotic returns for that matter. But at the same time, from another set of the investors who are HNIs, they want returns which are diversified from those of the normal stocks. They do not want they have a money in mid caps or the large cap funds or stocks, and if the market tanks or market goes up, similarly my alternate assets goes up. So therefore they want an asset class which is not bothered by how the stocks and bonds are performing. So therefore, that is the reason why it is important for high net worth individuals. So then it provides an opportunities for diversification. So when you have different strategies, different asset classes, private equities, infrastructures, and all other from a different type of companies altogether, different type of format altogether, this provides a very sufficient case for diversification opportunities for high net worth individuals. Obviously, the returns in these products, because they are very targeted, zeroed in, there are enhanced returns. So let me put it in perspective. When you look at the private debt structured AIFs, they are looking at some of the funds. Although whatever I say is not a recommendation here, or not I am recommending any of the funds here that have been quoted here, but they are just for an example on the information for the general public. So you would have seen that many of the AIFs have given an IRR of 14%. So that means a tax adjusted return is around 8% in the fixed income or a debt space. And there are many such funds which provide monthly payout as an interest outgo. So therefore, if I would say, I would not be wrong to say that they are also targeted as a product to provide enhanced returns. Because unless and until the product does not provide an enhanced return, why would an investor move out from mutual fund or a stock to go into say AIF purely on the basis of diversification, reducing the risk? No, but they also want better risk adjusted returns. So therefore, enhanced returns with the risk mitigations and better risk parameters, they want to have these alternatives available with the investor. So therefore, how an AIF is a very revolutionary vehicle. Put it through how it is happening here in India right now. First and foremost, AIF is a pooled investment vehicle, while I told it. Limited client state product, limited AUM, with a targeted investor policy statement, which type of investor they want to target, which type of opportunity they are trying to target, and then investing into it, unique opportunity. Then the commitments, as we say in 2025, are approximately 12 trillion rupees to it. That means there is going to be a 12 trillion rupees of investments into the AIF space as we see today. Then obviously there's a drive. What are the driving factors? We are going to see doubling of high net worth individuals in India by 2027. So therefore, there is an urge and innate desire to go for such products and alternatives in startup space, in SME space, in defense, EV space through an AIF route. And then AIFs are also classified into three categories. When we talk about category 1, which focuses on startups and SMEs or small enterprises, then we have category 2, which focuses on debt, private equity, and then we have category 3, which focuses on strategies of diverse equity strategies to generate returns with a mixed bag of unlisted or a pre-IPO shares within the same portfolio. Having said that, when we're talking about the category 1, you have socially viable alternatives. So you have venture capital. So venture capital looks forward for funding those innovative startups that have a huge growth potentials. And obviously they internally also look into the diversification because many of the startups fail. But overall, the return of the fund to be profitable, they fund enormous number of qualified startups as a part of their kitty. So therefore, in exchange, and they invest into these companies in exchange for the private equity, supporting the development and expansion. Then you have a SME funds, small and medium enterprises, vital to the national economy, and then SME funds provide capital to help them grow. And then you have an infrastructure funds, which is investing into infrastructure, utilities, and all such facilities. So this is when we talk about category 1. When we talk about category 2, AIF, they are into say private equity. Now private equity refers to the investment funds that buy and restructure the companies which are not publicly traded, not like a publicly listed company to the BSE and NSE. So therefore the capital is often sourced, that capital is sourced for the institutional investors or high net worth, ultra high rich investors, and allowing a significant growth and restructuring capabilities. Once we do this from the private equity space, there are another set of investors from the high net worth only, which do not want to get into private equity but private debt. They're looking at an income yield out of it. So therefore, these are that provide loans to businesses and individuals. Focus is purely on generating income. So we have seen there are many funds from the Kotak, also Kotak Credit AIF funds, which has provided very good yield on the returns. And then from the category 2 itself stable, we have the real estate. Now the AIFs that focus on the real estate, and if you see by all the news that is going on, majority of the investments in AIFs is happening into the real estate, and that too into commercial or even into luxury real estate projects, because that not only provides a good rental yield as far as the commercial projects are concerned, but also an appreciation of the capital gains that they are looking at based on the very good markets in the real estate space for that matter. Now then there is also funds of funds category, a fund which invests into another fund for the diversification. But keeping things simple, and if you are a high net worth investor and you understand only stocks or equities and you want an opportunity into an AIF space which is very much correlated, or you can say relatable to stock market, then there is a category 3 which naturally come with the hedge fund strategies. Now what happens? Let me put it. There are many funds which provide a long short strategy. So what does this long short strategy mean? Long short strategy means that in a portfolio they will have some stocks which are purely undervalued and they are buying it to hold it long, and then there are some stocks which are very overvalued and they expect it to fall and correct, so they will short them up, and therefore it involves taking long positions on undervalued and short positions on overvalued to hedge against market volatility. So this is a long short strategy as an example. And then they can have also mixed bag of say 30% allocation to private equity companies, or you can say pre-IPO shares which are just going to be listed over the next 1 year or a 2 year period, better diversification, all those things that come with it. So this is category 3. Now when we come into category 1, 2 and 3 in the AIF space itself, when we focus purely on fixed income, so we have seen that these are those where there is a consistent yield, income being paid out month on month basis. The XIR, their target is primarily around 14% in certain AIF providers, with the post-tax returns comparable value of around 8%. And they have been very popular over the recent past. So you have one from the stable of Kotak, you have one from the stable of Vivirti, and then there has also been very good decent returns as far as the fixed income thing concerned. When you come towards the equity side of it, like I said that in the month of December there had been a category 3 hedge fund from the Singularity, Singularity Equity Fund 1 that had given around 7.5% returns in the month of December for that matter. And then there are certain funds that use a mixed bag of private equity and stock markets both in their kitty. But then obviously many of these AIFs have provided a CAGR, or you can say not even CAGR, if you want to see the IRR returns of around 21.5% from 2013 to 2024 over the 10-year period every year. And then there are certain early stage funds which have provided around 26.5% return again from 2013 till now. So this is all that goes in. And when all these things are going in, much of the traction, like I said earlier, is also into the real estate space. And in real estate space, you have focus on commercial projects, luxury projects. You have the focus on rental income yields. You are looking at an appreciation of 9 to 12% as far as the income, or you can say rental appreciation or the gains is concerned at one end of the spectrum. And ultra high net worth individuals are getting attracted towards it. So it is not only related to commercial or you can say luxury projects. They are also going for infrastructure and an EV sort of thing. So that is also related to an infrastructure. When they are going for digital infrastructure like EV, they are going for infrastructure funds. They are also looking at some multiplier effect coming on into this type of portfolio over medium to longer term, because AIFs they go for a long-term gestation period, and it is not for an investor who is looking at quarterly returns of 2% or 4% on the kitty, but they're looking at the multiplier effect over a period of half a decade, to be very precise, at a lower end of the spectrum. Yes. And then again, why HNIs are flocking it? There has been a wealth expansion. They have more money to invest. They want it diversified, more alpha returns they are going to look forward to with lesser amount of risk being exposed to. The regulatory support from the SEBI has been to the AIFs, and many improvements in this segment itself as an asset class has happened. There's a global exposure because many of the onshore and offshore facilities have been here. There's an AIF that comes from the gift city, that is even the NRIs, FPIs and all those foreigners can invest into the AIFs that are being launched from the gift city Gujarat, the Gujarat International Finance Tech City for that matter. And also there are many high net worth which want to have an exposure into companies and support those companies and make money through those companies which are focusing ESG, environmental, social and governance part of it. But again, yes, with all those things, the uneasy lies the head under the ground. There are certain challenges to it. Also, the main challenges are not every investor can opt for it. It is a high ticket investment of 1 crore and above, and the multiples of thereof. And the second thing is that there's a liquidity concern. If you don't have a long-term period to multiply your wealth, you are not cut it out for this, because many of these AIs are structured such that it has a startup investment, it has private equity deployment, private debt deployment, so which might have certain period of holding in them required at least, and the patience on the part of an investor. There could be a tax complexity of it, and then there is a strategic approach that an ultra high net worth individual should have. So your thought process, psyche, and your need as an investor should match with what the product you're opting for. So therefore, the next time any AIF comes down on your table or a brochure on your table, doesn't mean you need to apply for it. You have to see that whether that investor policy statement for that product is actually suitable for you or not. So thank you so much. This is Rajat signing off, and have a great day.